Good morning, everyone. For the record, it is July 29th, 2021, and this is our weekly BDA training. And for our conversation today, we have Matthew on. He is our point of contact over at F&G. So for those who don't know, 3Mark just brought on to the family F&G Annuities, as well as National Western Life as well, but we won't talk about that with Matthew. And for our conversation today, I wanted to bring Matthew in because F&G has some really unique products. They are right now #2 in the annuity space, and they're definitely gunning for Allianz. And so I want you guys to listen to some of the things that Matthew's going to talk about. This is going to be much more conversational. So feel free to ask questions. You can either unmute yourself or put it into the chat bar. But as I said, Matthew, as we were talking, everyone that's here are all marketers, basically. So they are all distributors. So this doesn't need to be a formal presentation, and you don't have to be on your best behavior. This is for us to be able to have a conversation and learn what we need to about really answering the question of why should agents have F&G as part of their product portfolio. So I'll pass the floor on to Matthew. You can share your screen if you want to. And then, like I said, let's the show is yours, and then we'll ask questions in between as we go along.
Yeah, thanks, Dave. Thanks for the opportunity here. Yeah, what I try to hit on just top level, I feel like F&G doesn't get a lot of introduction in the marketplace. As you said, we're #2. We actually grew about 27% last year. Every single one of our competitors, at the top level, competitors at least, lost market share last year. So you got to be doing something right. I'll attribute that to a couple things here. First of all, is we very much have like this is kind of an intangible, like a startup mentality, maybe. Like we're a scrappier company, I guess is what I would say. We're very, very flexible with making sure things happen for advisors and for clients, much more than our competitors. I hear that every day. You mentioned one of our competitors that I hear a lot about. If you look at the top 5 IMO channel annuity providers, annuity carriers, you're going to see kind of where we're taking business from just because of the way we operate as a company, right? So I think you'll find that we're easy to do business with. We're very approachable and a lot less corporate than our competitors, I guess. Now, the other thing I contribute that to is I think just the strength of the products we have. We have Blackstone actually handles our separate account. Blackstone is, and every time anybody asks me about Blackstone, like explain that company to me, I tell them just Google Blackstone, right? The best money manager in the entire world, one of the biggest. They've been able to provide us really a lift with pricing that our competitors don't have. We'll talk a little bit about when I go into this product I have up on the screen here. We'll talk a little bit about why that's important to us as a company and how that really, I guess, manifests itself in the products themselves. And then also we have a parent company now called F&F, Fidelity National Financial. So we're owned by a publicly traded company, which I think is a big deal. It should be a big deal for clients. We're not a private equity owned company. F&F is the biggest title company in the world, so it provides a nice counterbalance, right? Because when mortgage rates are very low, like they are, a company like F&F is very successful, right? Almost printing money there. Typically, when rates are low, a company like insurance carrier is going to have issues, sourcing the right investments to promote their products or support their products. That provides a nice yin and yang for us to be able to stay at the top of the market. And then combine that with Blackstone being able to provide us with the profitability we need on the separate account on the insurance side, is really giving us a boost to have what I think are the best products in the industry. Now, there are some niches where we lose out on. One thing, just to be transparent, is we're working on a increasing income product. We're working on more of the immediate income for younger clients, so the guaranteed income product. Those are really only the 2 sections that we lose out on. What I'm focusing on, I don't think, honestly, we're still competitive in those. We're talking about dollars and cents here. What I want to focus on, though.
Hey, Matthew.
Is, yeah, sure.
Quick question. You said 27% growth, took market share away from all your main competitors in the IMO channel. Who are you said top five? Who would you tick off as the top five?
Well, you go down the list, like Allianz, Athene, North American. But those are really our competitors, right? Sometimes we lose out to companies like Delaware Life and sort of the smaller carriers, Global Atlantic, but it's very, very rare that they'll come up in competition. Our main competitors in this channel and for the advisors that we work with, and I'll talk a little bit about our bonus program too, which is part of the reason why. The advisors that we work with are primarily writing those products. American Equity is another big one. So those are really probably the four main competitors that we're up against. Yeah. And you can see with product design as well. You can see that everybody is kind of trying to take market share from everybody in that space at the top, I guess. So it's kind of interesting. But we have really, I think, a unique product here. Hoping you guys can see this. This is a microsite for Power Accumulator. Product was brought to market in 2019. This has been a massive recruiting tool for most of our IMOs and FMOs just to bring people over, just because of the way it works. And I mentioned it's an elegant product. I think it's elegant because it's so simple. This has really been our fastest growing product, and accumulation products are really it's really our bread and butter. The way this product works is zero floor, right? Client can buy up. I'll show you a little bit here. They can buy up higher rates. We have some rate guarantees. I'll show you a little bit as well. But the star of the show here is the index itself is on this product, Power Accumulator. It's a balanced asset 10 and balanced asset 5. Let me just see if I make sure I'm sharing the right screen here. This is a balanced asset 10. So this is from CIBC. It's a Canadian investment bank. Essentially what this is, and again, I mentioned it's very simple, and hopefully this will click. It tracks two BlackRock ETFs, the IVV, which is an S&P 500 BlackRock ETF, the TLT, which is a 20-year Treasury ETF, and then there's a cash component in times of high volatility. And then there is an over-leveraging component up to 150% in times of low volatility, right? So you can get up to 150% of what those ETFs do, or it'll move into cash if it needs to protect itself, basically. That's how all indexes work here in the industry. But the great thing about this product is it essentially sticks to a 60-40 split, 60% into the S&P ETF, and 40% into the Treasury ETF, right? And then there's a cash component. So there's essentially two moving parts plus cash, right? I am not aware of an index in the industry that's that simple. And the good thing about this is you're talking about something that people are probably already invested in, right? People that are retirement age probably already have 60-40 portfolios somewhere. So they understand how they work. They understand the S&P. Some of you probably understand treasuries, but they understand that this is a heavily equity-based index on a fixed index annuity, right? So again, zero is your hero. There's no downside. You're talking about something that essentially is going to stick to a 60-40 split throughout. And obviously, if it under and over leverages, the calculation gets kind of wonky. But it's essentially sticking to that. So like what's happened in the last year or so in the industry and with these indexes is they have kind of hit away in cash or hit away in the treasuries, hit away in bonds because there's a lower volatility. They've just gotten hammered, right? I mean, like full on half of the indexes in the fixed index annuity space right now are negative or they're flatline or less than 1% in returns year over year, right? When the S&P did like 50% from where it was about a year ago. So this product is very, very simple. This index is very, very simple. It's easy to explain to clients. And the cool thing is, and I've shown you the 10% volatility here, we have a 10% volatility option for this index. There's a 5% volatility and a 10% volatility. We'll look at a rate sheet here in a second. 10% is a lot of volatility. So you essentially with the fixed index annuity, you have a volatility control chassis, volatility control product, and you're adding volatility control to it by the index, right? You can tell me if this is getting too wonky or whatever, but by doubling what's typically offered, typically the volatility appetite on the index, what you're doing is you're allowing the index in the FIA in the power accumulator to essentially stay where it's most productive much longer. Like you could say double because it's twice the volatility appetite, but it actually ends up being more than that. So what it does is it doesn't start moving into cash, doesn't start moving into those really conservative sectors or ETFs or whatever as quickly as a 5% volatility strategy. You know, a lot of 5% volatility strategies will rebalance daily. This one rebalances monthly. They'll 5% volatility on a day-to-day basis is not a lot, right? 10% is a lot for the equities market, even for the bond and treasury market as well. So that's the primary difference on this one. And like I said, there is a 5% volatility on strategy on this product as well. And there's some advantages to that. I'll show you. But this to me is a rock star index. If you look here, this is a 2-year return. 1-year return 13.69. So with all the volatility that's happened in the last year or so, the true return on this, and again, backtesting and everything like that is literally 2 pieces plus cash. It's 27.13%. Right now, there is a spread on the 10% volatility part of this product, a 2-year strategy, a 5% spread. Now, I'd be hard pressed to find a client that would not be happy with a 22.13% 2-year return on a fixed index annuity where they have no chance of losing their money. Okay, I'll show you here while we got this up here real quick. Here we go. I'm sharing the red screen. This is the 5% one. 5% version of this. It's still over 12% on the 2-year return, 6.28 on the 1-year return. Okay, so I'll show you what the rates are here in a second, but essentially, this is kind of our ace in the hole. I think this index that we have it on a couple products. I want to focus on just accumulation, but the 5% volatility on this is actually available as well on our flagship income product, Accelerator Plus. So essentially, what you have on that product really great opportunities to grow the account value and a lifetime income rider. So we can probably want time for that product today, but we can definitely circle back. If you have anybody that's interested in income, especially younger clients, lifetime income, that is the product to beat. We did a analysis of everything else in the market in competition, and it hits a sweet spot for compensation. First of all, 10-year returns on it, the payout factors, and the lifetime income amounts. Right, so it really kind of hits a sweet spot on everything that product does. It's a little more in depth than probably we have time for now, but we can definitely talk through any cases you guys might have.
Matthew, so I want to take a quick.
Yeah,
I want to take a quick step back. So, because I know some people in here are slightly newer to the annuity world, but
okay,
the Power Accumulator series. First and foremost, is so that everyone understands how powerful this is. A lot of the bonuses and usually above 100% participation rates are typically reserved for the income portion of annuities. So to have something that has the ability and the potential to do this much on the interest crediting side in an accumulation chassis, a fixed index annuity, is really, really rare. I mean, I know, and that's why you're stealing some equity share from American Equity, probably from their Asset Shield product.
Correct. Yep.
They're 2 years. So be aware that this is, and I will tell you, because we do a decent amount with American Equity, to get this type of there's not this type of simplicity in index strategies. So a 60-40 split is very easy to explain for a lot of the agents and advisors. Whereas to do that within another product within, for example, American Equity, you're usually splitting it between the 4 no-fee options that are on there, and creating that hedge, which I know is sounding fancy and stuff like that. But this is very simplistic, very good on the accumulation side. And what was, I think you're going to get into it with all this, but what is you have a 5-year and a 10-year surrender period?
7 and a 10, yeah. So it's hard to show this fully here, but what I have highlighted here is the 10-year. We'll focus on the 10-year here.
Yeah.
So these are the rates. So I haven't even talked about, there's a lot of, this is a really fantastic product because you can actually track individual ETFs, iShares ETFs, which iShares is obviously the biggest name in ETFs, BlackRock. These are the rates for that. I don't want to get too deep into that, but just know that there are 1 and 2 year options for clients. As far as, let me zoom in a little bit. As far as if they want to really truly diversify within a fixed index annuity, which is wild, right? I mean, these are just straight up tracking ETFs. You know, real estate gold. This one's international, and then the S&P 500. They'll get a par rate, usually a spread as well. You can, in this product, you can actually just, I mean, it doesn't get any simpler than that. It's even more simple than the index we were just talking about. You can actually just track the ETFs themselves, right, with no downside. So considering there's no downside, these are actually really great participation rates. So. I want to just focus on the index for a second here. So we talked about this. Here are the 10. Like I said, these are the 10. I don't know if you can see my mouse, my cursor here, but these are the 10-year chassis numbers here. On a 2-year strategy for the balanced asset at 5%, there's a currently 130% participation rate. I'll talk about the guarantees in a second. I'll give you the illustration, but the buy-up, here's one thing I want to point out here, is the buy-up options on ours is 1.25% fee here. On a 2-year strategy with us, anytime there's a 2-year strategy, if you're buying up a higher participation rate, in this case, it's another extra 40%. On a 2-year strategy, you pay that one time, right? So that fee is paid one time. Very important. So it's paid at the beginning of the 2-year strategy, not on an annual basis. Huge deal because essentially, and the math isn't perfect because there's a compounding effect, but you're talking 0.625% fee taken out of the account value to get an extra 40% par rate on a 60-40 split index within a fixed index annuity with no downside. Okay, so it's very typical to have a fee, a buy-up fee. 1.25 is about average for a 1-year strategy, but for a 2-year strategy, this is the most affordable buy-up fee on the entire market. Okay, I don't think I'm never say never. There might be a B-rated carrier that does this, but you won't. And from my experience, you will never find an FIA, a fixed index annuity, where you can buy up any more participation, any more upside for less than 1.1%, maybe 0.9 in some cases. And for us on a 2-year strategy, it's 0.625%, basically. Or 0.6. What's my math here? 1.25 divided by
that math
2.
is 6.125.
0.65. Yeah. So, does that make sense? I just want to pause on that and make sure.
Would you say, Matthew, that most of the carriers that are doing a 2-year strategy, do they charge that fee every year?
Correct. Yep. And most of them, a lot of them, I shouldn't say most, but a lot of carriers, what they're doing is you have to choose when you issue the contract if you want to have the buy-up option every year or not. Right. With us, anytime there's an anniversary, so on a 2-year, it'd be in 2 years. On a 1-year, it'd be in 1 year. You can say, yes, I got my money's worth from that buy-up option. I want to continue it. Or you can say, no, I didn't feel like I got my money's worth. It's too much risk. I think there's going to be a market correction. I don't want to put any of my principal at risk. So I am going to not go into the buy-up option, right? So you can just go back into the no fee option. That's something different with us. Like sometimes if you want the buy-up option, I think American Equity is like this. If you want the buy-up option, you have to lock it in for the whole 7 or 10 years. So ultimately, there's flexibility for the client here. They can do any type of combination they want between the fee and the no fee, 1 year and 2 year. And the fee itself is very affordable in the 2-year strategy.
That makes sense.
That's a great question. Yeah. So that's the 5 I was pointing out. The 10% volatility does not have a buy-up option, but here's 100% participation currently, the 5% spread, right? So if we'll look at the historicals in a second here, but that spread basically means that the client doesn't get the first 5% of performance. Historically, especially if there's a low volatility increase in the market, you're talking about, I think it's like 7 or 8% annually. This index is done after that 5% spread. So it's basically the trade-off for having a 10% volatility strategy. And I should say this as well, if you're talking about competition, most 10% volatility strategies in fixed index annuities are either multi-sector or they're international, or there's some combination of things that makes them not perform well. So it's good to have a 10% volatility, which is, obviously going to keep it into the equities and things. But when it's tracking, South American stocks or something like that, it's not effectively doing anything for the client, right? This one is a 60-40 split. American equities, yes, excuse me, not American equity, I shouldn't say that. Equities in the United States, S&P 500, the 20-year Treasury, right? So that combination there is really killer, and it's not, as far as I'm concerned, not matched anywhere else in the market. So that's my pitch on that. I know you'll see some people with, or some indexes with higher volatility on there, in the 10% range, but just keep in mind what they're actually tracking, okay?
Yeah. So on the power accumulator series, would you say that the iShares and the balanced asset are the kind of the two most popular crediting strategies that you guys see that people are choosing? Or what is that?
Yeah, it's actually all that's available. Yeah, it's all that's available on this product.
Okay, gotcha.
We have the Barclays. Yeah, the Barclays Trailblazer is a multi-sector 5% volatility control index. It's available on another accumulation product. It's more of like it's been around actually. It's kind of an OG in the industry here as far as a fixed index annuity index goes. It's been around for I think 7 years now. It's actually the most popular index in the entire industry. I think there's like $5 or $6 billion allocated to it at any given time here. However, the reason why I haven't focused on that is even though it's so popular, it's historically been so popular, is that everybody has a version of that now, right? Yeah. This one is unique to F&G. This index is unique to F&G, and the way it works is unique, at least for the time being. So we're lucky to have it. But yeah, good question there. So here's one thing I want to point out too. We're talking about BlackRock, Blackstone. We're talking about our parent company. One thing that we do a little differently here is we have on the 5% volatility strategies, we have, and this is across the board, on this product on Barclays as well, we have 100% minimum participation rates. So you see them here? I'm going to highlight these. So whenever you see a 5% volatility index with F&G, your client is not going to go below 100% participation rate throughout the life of the contract. Okay, so very, very important. Some of our competitors, I should say, there's one that I didn't mention. I don't consider them a long-term competitor, but I will say that their products are named after mountain ranges. Are very, very, they offer very, very competitive upfront compensation and very, very competitive introductory rates. Okay, we're at the point now where we're seeing renewals on them where somebody might have 175% participation rate for the first 2-year period. They're getting down into the double digits, right? They're getting down 60, 50, 40% participation rates. F&G doesn't do that. We don't have to do that. We would rather lose the business up front if that business is going to go to a different company because of introductory rates, that's fine. Over the course of the 10-year period, we're confident that by offering certain guarantees on the rates every time the client's 2-year or 1-year period comes up for reallocation, we're confident our product will outperform, right? And it'll make them happy. 100% is a magic number for participation rates. For people, they don't want to see it below that. So a very, very important distinction for F&G is that we offer contractually guaranteed minimums on our par rates. That, as far as I know, none of our major competitors do. Not on the 10% volatility, because that's we just can't do that. That's it's not possible. I guess it's just not, pricing wise, it's not possible. And every time there's a 5% volatility strategy, including this balanced asset 5, that is available. So I'm just going to show you right here kind of what this looks like in an illustration. So I know we're running out of time here.
We got, like I said, we got till 10:30 for you.
Oh, you do? Okay, gotcha.
Yeah.
I thought we had half an hour. My bad. So
you can slow down a little bit.
Okay, good. Yeah. So I thought we had 30 minutes for some reason. My calendar's not up. So here's just what this looks like in an illustration, right? We're talking about there are some time periods here where there was zero growth, but on 2-year strategy, averaging, let's see what the averages are here. Most recent period is 9.26% annual growth, and that is geometric growth, so that is compounding growth. It's actually slightly higher if you take simple interest. The lowest period in the last 20 did a 5.51% annual geometric growth. That's with quite a few years of no growth. In the highest period this is done is 9.73. So that's kind of the power of a 10% volatility strategy. Obviously, we've had a great bull run, but even the lowest 10 years here, you'd be hard pressed to find somebody who you talk to them and tell them you're never going to lose your money in this product. But the lowest period we've had is 5.51% a year, right? And that's going to be MIGAs, fixed annuities. That's going to be CDs. It's going to be most bond funds. It's going to be a ton of mutual funds in the market, and you can lose money in those investments. So obviously, historical performance is not guaranteed, but this product specifically and the way the index is really designed to, I guess, just grab onto the market if it's going up and just hang on for dear life, right? In a way that I think a lot of, including our Barclays, I'll admit, a lot of indexes are not. That's my little soft pitch on that. So let me ask you, do you guys have any questions right now? Sorry, I rushed through because I thought we had half an hour. I apologize.
It's
we can go back and
Matthew. I
talk
should
through
have been clear
whatever.
at the beginning. No,
I don't have my calendar up either, so.
No worries. Well, so a power, this is specifically what we went over is the power accumulator series. There's a 7-year surrender product and a 10-year surrender product.
Yeah, and what I'm showing here are the 10-year rates. Yeah.
Gotcha. So and then on the power accumulator series, the only two crediting strategies are the iShares and the balanced asset, correct?
Yeah, right here. So you have these 4 iShares you see here. And all these go back, I think, at least 15 years. I think the Gold Trust one, the real estate one, are not as quite as old. But the other two, I think, have been around for at least 20 years. So your options essentially are in this gray box and below here.
Yep, I'm still seeing.
I'm sorry. The screen share stopped here.
No worries.
Yeah, apologize. So those are your options, right? So we'll see generally like some kind of combination here. Like, so the thing is, the 2-year strategies have the best performance, right? Especially the balanced asset 10. It's only a 2-year strategy. The one I just showed you has the best performance of all of them. The 2-year rates for the balanced asset 5, it's about 40% more participation on the no fee option than the 1-year strategy. So typically people are doing something like putting some of the money into a 1-year strategy when they issue the contract. So they'll do a 1-year strategy, half the money in it. So say it's $100,000 initial premium. Half the money will be in a 1-year strategy, half will be in a 2-year strategy. So what they'll do is they'll take that money after the 1 year after the 1 year is over, and they'll move it into a 2-year strategy, right? So they're getting the benefit of the pricing power of the 2-year strategy every year after the first year. We call that laddering, because it looks like climbing up a ladder with a 2-year strategy. That is what we'll generally see people putting money into these iShares. Now, some people like to. Let me just pause there. Does that make sense? Have you guys heard that before?
Yeah, I was going to say I was going to reiterate once again, because that is a real. Many agents, advisors are going to be familiar with it, but you being able to, if someone's asking you, well, hey, what are the crediting strategies that are typically done for this product? Because that's something that you'll get asked. That's why understanding this is important. And then the idea of laddering, so that you can show the agent can show a client returns in every year that they do an annual review, which is really important. So put a 1-year strategy at the end of the first year, the policy anniversary, switch that 1 year to a 2-year, and then put the other 50% in a 2-year, and then you have that laddering that goes on.
Yeah, so that's very, very popular, and that's, I would say, for our 2-year strategies, obviously the pricing is much better. And our Barclays example, index, for example, doesn't even have a 1-year strategy. So very, very important, like you said, Nathan, right? To have every year to have some crediting, and to get your client the best possible pricing that you can, and the best possible pricing is on the 2-year. So I talk to agents all the time. They have no idea they can do that. Excuse me. So it's I'm trying to be an evangelist, I guess, for that strategy, because it really does make a lot of sense. I mean, if you look at some, let me just do math here. If you look at somebody, if the S&P is truly up 50% this year, and you have somebody who, so somebody who had done this last year, and that's obviously not a common year. I mean, they'd be looking at like 14.5% on the S&P 500. They could take those gains, move them into a 2-year strategy, get even more pricing power on a go forward basis, right? So, very, very important little tool to have in your toolbox when you talk to people, because the number one objection to get about 2-year strategies is, well, it's too risky from the perspective of the market. What if it's down? What if it's up for 2 years? What if it's up for 1 year and 11 months and then it crashes at the end of the year? That's a valid complaint. And I want to have crediting every single year, right? So this helps to mitigate that a little bit. Because the idea here is to just get as much money as possible at the end of the 10-year period or however long they keep the contract.
So moving on to that, so that's the power accumulator is, that sounds like your number one product right now, correct?
Not number one in sales, number one in growth. Yeah, it's so the balanced asset 5 wasn't added to this index until March. The product itself is just, it's not even 2 years old now. It'll be 2 years old in a couple of weeks. So this is the number one growing product. And the reason why I like to mention it in calls like this is that a lot of marketers are actually recruiting non-fixed index annuity producers into writing fixed index annuities because of this product, right? I hear that every day. Like I have this RIA producer who is looking for something for more security. The bond market's crazy. They can't make any money on it. So they're coming to F&G specifically for this product. So as a recruiting tool, it's actually really powerful for you guys. So that's why I like to focus on it for this. But the Accumulator Plus that has the Barclays Trailblazer is actually, I think, still the number one seller by a factor of like 50%. It sells 1.5 times as much as this currently.
So really quick, since you have time, I mean, before we move on, because if you can do a quick run through of the other products as well. But before we do that, just take a minute. Does anybody have any questions about the Power Accumulator series with the iShares and the balanced asset indices? Anybody have any questions about that? All right, there's going to be a test afterwards, so you guys better have all paid attention.
One more thing I want to talk about, because sorry, before we sorry, go ahead. Yeah. This is your time. Man.
No. Go ahead. I didn't have anything else. I was going to say next, after you go through what you're going to go through real quick. Like I said, let's do a quick run through of the other products then as well.
Okay. Yeah. We'll make sure we talk about Accelerator here. The only thing I want to point out too is we're talking to agents, especially higher producers. We do have a cash bonus program, kind of in line with the rest of the industry. Ours actually pays more than all but one, I think. It depends on the scenario, actually. So 3 million is the threshold. So there's 3 tiers: 3 million, 5 million, and 10 million. If you do 3 million to 4.9 million in fixed index annuity production, we'll pay an 8% bonus on all eligible commission. From 5 million to 9.9 million, we'll pay a 12% bonus on eligible commission. And then 10 million plus, we'll pay a 16% bonus on eligible commission. So it's paid in a lump sum the following February. We used to have kind of a complicated power producer program, but this has really brought it back into the rest of the marketplace, kind of modernized it. So keep that in mind. There is a bonus program with us. It's very, very competitive. That's just extra money in an advisor's pocket. We do pay pretty well. Our upfront commission is actually pretty high, but this is just another cherry on top. Excuse me. And again, this is not 8% of the premium. Of course, that'd be crazy. It's 8%, 12%, and 16% of any paid commission, any actually paid commission.
Yeah, I was going to ask that. I'm like, that's a crazy number right there. That's insane.
Yeah, I do like 20%, or 22%, yeah.
And I will just
do yeah, go ahead. Yeah.
I was just gonna say, I will say there are only a handful of carriers that really do bonus programs for the agent. There are some IMOs that'll do bonus programs and things like that, or marketing dollars, but that's extra money in someone's pocket. That's an agency that's doing a lot of premium and they pool that. Yeah, they have an agent that's doing, they're a high-end producer. They're doing already 2, 3, 4, 5 million. That's pretty key to get them more money in their pocket, which allows them, especially if they're doing seminars, that bonus pays for a seminar or two at least. So
For
good,
sure, yeah. Yeah.
something to be aware about. That, like I said, some of them may never achieve it, but just the idea that there's a bonus there is a good thing to talk about.
Yeah, for sure. Yep. And we hear, yes, it is tax, and people don't like that, but it's like most people most advisors I'm working with who are a little more sophisticated are basically, they know they're going to put that back in their business as a business expense, right? Just going to help them get more money. So, icing on the cake. So,
other really quick, like I said, other products then. So we went through the power accumulator.
Yeah.
And then this is the Accelerator Plus.
Accelerator Plus, yeah. So I was trying to whip up an illustration here while we were talking. So,
No problem.
this is $100,000. This is our flagship income product. It's a performance-based income product. It is top of market right now, and I'll show you kind of why. So it is. I'm trying to think how to say this so in a compliant way. It hits the sweet spot on compensation,
we'll strike that
performance, and account value. What's that? Scratch it in the record. Yeah. I have some internal data, but I can't show you guys, unfortunately. So it hits the sweet spot for on the guarantee. So it does a lot of things, I guess, and we'll talk about that. As far as being a performance-based income product with a guarantee on it, guaranteed roll-up, it's the top of the market. Historical performance is at the top. Commissions is close to the top. And then payout factors and everything that come into the calculations there are also either at the top or close to the top. So in my opinion, this is mathematically, I guess, this is the best income product in the market, a performance-based income product. Again, this has the Barclays and the CIBC Balanced Asset 5 on it. So you're getting similar participation rates and crediting rates that you would get on the Power Accumulator on an income product, right? So fantastic combination of a bunch of different things. 100% minimum participation rates, which is extremely important, probably even more important on this product than it is on the accumulation products, because on income products, you're talking about potentially a lifetime contract, right? For the life of the client. Very, 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 very important to have some sort of minimums on the par rates, because, and we'll talk a little bit about why, but just basically because you don't want somebody to be stuck with a lifetime payment they're getting. It's very, it's tough sometimes to justify moving to a different contract and starting over again with a lifetime income. It's very, very important to have some kind of guarantees for them, so they have some kind of I hate to say like safe haven, or like there's something that they can fall back on, that they know this product is going to be there for them in the long term, to help them out and work for them, right? I can leave it at that. And you guys,
I'll just say from my perspective, Matthew, the guarantees within income, it allows an agent or advisor to mathematically show this is what your income is going to be no matter what. And then outside of that, well, here's what the potential is. But in the income scenarios, that is a huge differentiator to be able to say, okay, well, here's your guaranteed income. It could do other things. I think a lot of agents and advisors don't, especially in the income side, shouldn't be talking about the potential as much as more as the guarantee. Because if they can show a guarantee and it's a good guarantee, then it's a great product. And whatever it does above that, that's extra that the agent gets to talk about. But it may never come to fruition.
We'll talk. Yeah, and this is important because ideally with a product like this, you're not only selling the income story, the income side of it, you're also selling the accumulation side of it. That's the idea with a performance-based product like this. So to have the ability to grow the account value and continue to grow the account value as well, and have some sort of minimum guarantees is actually very, very important, right? So we'll show you kind of what that looks like in a second. But our income products have bonuses on, our accumulation products do not. We have guarantees like we talked about on the rates. The other carriers don't. The philosophy here is you got to pay the piper one way or the other. If you pay them with a bonus up front, it's going to cost you long term. The idea is that we'll have some guarantees on the rates that over the course of the life of the contract are going to be more beneficial for the client, and our consistent rate setting is going to be more beneficial for the client than any type of upfront bonus is going to be. Okay, so that's kind of our philosophy as a company. It goes back to our of how we function and how we're a little more conservative with how we build out the products. But our income products with the riders do have upfront bonuses. Rider charge is 1.15% annually, kind of in the middle of the road there. So let me talk about this product a little bit. We'll talk about the guaranteed portion of it. This product has, it's a performance-based income product. The idea is the account value will grow and it'll push up the income base. But in case that doesn't happen, there is a 5% roll-up, 5% guaranteed compounding roll-up on any premium paid in the first year.
Hold on there. That's important what you just said. You just said compounding.
Correct. Yeah. Not simple interest. Compound.
That's
interest,
a big deal because most of the other roll-ups are simple interest roll-ups. So I just wanted to make sure everyone caught that. Take a note. That is 5% compounding.
Right. Yep. So this contract will that's a backstop, right? And mathematically, as far as I know, we've never had a time period since this product launched like 8 years ago where anybody has actually had to use the 5% roll-up, or that's been the calculation used for the income base. But just know that is in the background, and that is actually extremely competitive, right? I mean, you can find carriers with guaranteed income products with no growth opportunity that are 5% roll-ups or worse, right?
Mm-hmm.
So I just want to point that out. Our competition does not have this robust of a backstop on performance. So let's get into an illustration here. Now this is using the balance asset 5, which is similar to the one we just illustrated. I'll show you kind of how this product works. Okay, so what you do is you take the account, in any given year, you take the account value, and there's a multiplier, and that gives you the income base. So the way this product works is the longer you wait, the higher the multiplier goes. So it goes up in 5% increments every year, 5, 10, 15, 20. You can put a 1 next to these. It's basically 105%, 110%, 115%. Tops out at 150%. So if we look at year 10 in this example,
account value. Hey, Matthew, real quick, I think the screen froze again. We're still.
Oh shoot, my bad.
We're still at the illustration.
Oh shoot, sorry.
No worries.
Shoot, you probably didn't even see this stuff. I apologize. Let me just go back a little bit. So here's the same screen we showed on the last illustration. 1.15% fee. There's a bonus on here, and here are those 100% minimum guarantees that we went into depth on, right? So very, very important. Just want to make sure that I just want to make sure I point that out and pound that into everybody that we have 100% minimum guarantees on the 5% volatility strategies that we have. Something that not every carrier does. None of our major competitors do. So here's what the 5% guaranteed roll-up looks like. So there is a 5% guaranteed compounding roll-up. We just talked about that. I apologize, I didn't have the screen up.
No worries.
So the way this product works, again, is zoom in a little bit here. On it, it's 100%, $100,000 initial premium. The roll-up is 5, 10, 15. You can see it's increasing by 5% annually here.
Mm-hmm.
What you do is you take, and this is the best way I know to explain the product. This is why I don't do PowerPoints on this product anymore, is because nobody can understand it if you explain it in a PowerPoint. In this scenario, the account value has grown after 10 years from 100,000 to 189,000, almost 190,000.
Mm-hmm.
You take that number, you multiply it by this performance multiplier to 150%. That gives, because they waited 10 years, that gives you the income base. Is of course meant to grow much faster than the account value because of that multiplier. You multiply that by a guaranteed withdrawal percentage. For the age of this client here, it's 5%. That gets you a guaranteed withdrawal payment, right? And again, account value times this multiplier gives you income base. This is based on the age of the client, the withdrawal percentage payout factor. Get you a guaranteed withdrawal payment, in this case of $14,000, guaranteed for life for the 65-year-old. Now, it's an annual payment. Now, one thing we do is we have what's called an income doubler or an impairment multiplier. It's ADL based, activities of daily living based. 2 out of 6 ADLs. If the client cannot perform them, they would be eligible to double the payout amount. In this case, it's a little over $28,000. You'd be able to double the payout amount until the account value reached 0, until they passed away, or until they decided, or until they no longer qualified or decided that they no longer wanted that doubler. So that's also a very, very important thing to keep in mind when you're talking to what kind of guarantees are on the products, what kind of backstops are there to protect the client. We have this impairment multiplier included to help a client in the event of, really we're talking about basically end of life scenarios, right? We're talking about nursing homes, we're talking about injuries, things like that. There is this doubler on there to help them get the money out of the account faster. Now, we also have a similar rider for the account value on all of our products, where as long as the criteria are met, the ADL criteria are met, there's also a confinement rider as well. We would allow them to liquidate the contract at any given time and take the gains with them without penalty, right? So without the surrender charges being applied and MVA being applied, things like that. So we have built into our product for no fee. It's all included in the product. Sort of, I guess you'd say, release valves, right? In case the client has issues, health issues, or severe issues with end of life type of things, confinement, has to go to nursing home, things like that. We do have ways to protect your clients and not force them to continue a contract if they're not able to.
Gotcha. Real quick question, just looking at this illustration, year 11, why does the withdrawal payment go down?
A 2-year strategy. So what happened here is the fee was taken out this year, but there was no growth.
Gotcha. That makes sense.
So that times 150. Yeah. So great question. Yeah. So that's why that can go down. That's why the laddering strategy we talked about is very important, to have crediting every single year. I cannot illustrate that, but I can certainly talk about it.
Yeah.
What I'm going to do here is I'm going to do the same illustration, but I'm going to do withdrawals after 10 years. Okay. I'll show you kind of what I think is the most important part of a product like this. I'll share my screen here in a second. Apologize, drop there. What I think is an angle that people don't think about a lot when they're talking about products like this. And it's very, very important. Let me just load this real quick.
And as you're loading that, just so I understand the chassis of the product, you have the crediting strategies there. The crediting strategy is for the accumulation side specifically. So you don't have an interest credit bonus, correct?
Yeah, good question. I had that question yesterday actually come up, and then we don't have the bonus does not directly apply to the income base, because the income base is credited to it's tied to the account value. So technically, the bonus does push up the income base, but only because it's tied to the account value. So it's not. Again, this is a performance-based product. Our solid 100%, guaranteed income products like our Safe Income Plus, they do an income-based bonus. On this one, the bonus is it's a little removed from the actual income base as a bonus, but it's still tied. It still happens because it's tied to the account value. So anything that pushes up the account value pushes up the income base. That's how this works. Yeah,
which is important differentiation between other products, because like I said, usually what you have is the idea of you create 2 buckets, and then you have the crediting strategy is really high on the income side, but then it's significantly lower on the accumulation side. And then plus on the accumulation side, you still have a fee that's going that's stacking away at the accumulation side, where the crediting strategy is on the accumulation side. And then because of the multiplier, it changes the withdrawal basis, which is really important differentiation. Like just the chassis of the product is different than most other income annuities that are out there. So one of the biggest complaints, and sorry, I'm hammering on this, but one of the biggest complaints about for a lot of agents and clients is that most people don't actually turn on income. So for a product that has the ability to multiply the income, but it still affects the accumulation. If someone never turned on this income over 10 years, their account value is, their accumulation side is going to be just as competitive as with another accumulation product, basically. So sometimes it doesn't hurt as much to put the product in here because you're still getting great returns. Whereas you look at most illustrations on an income product, that accumulation account value or the accumulation crediting strategy is significantly less attractive than the income side is.
Right. Yeah. Yeah. And that's actually, that's a good segue here, because what I want to point out here is, same illustration as before, but the client turned income on after 10 years. At age 66, this is a very common use for this product. You're going to have, say you're 55, you open the contract, excuse me, you know you're going to retire at 65, or maybe you're not going to retire at 65 and you want to have some money to help bridge the gap between Social Security or, you know, pension, things like that, when you actually stop working. Very common for them to keep this product, to keep it in for 10 years, turn the income on after they turn 65 to 66 years. That's just how it shows. So clients getting $14,000 a year, the $14,232 that we were talking about a year. But the account value still has the opportunity to continue to grow as much as it can, right? So obviously you're taking money out every year. But the idea here is that instead of the account value eventually getting to zero, the idea here is that you're going to be able to get lifetime income and have money left in the account, right? So what that means is, in this scenario, for example, and of course, last 10 years are special, right? In this scenario, for example, the client has put $100,000 in initially. At the end of year 20, when they're 75, they've taken $142,000 out of the contract. The account value is still over $125,000, right? So if they passed away at this point, their beneficiaries would be able to have, in this particular scenario with this illustration, $125,000 left, even after the amount of money that the client has taken out. So in my opinion, everybody kind of spreadsheets and looks at the guaranteed income products and says, oh, who has the highest roll? Who has this? You know, highest payout factors. They're missing products like this. This is why this product is becoming very, very popular with us as the word gets out, is because what you're able to do is you're able to do the best of all worlds with one annuity. You're able to have a client who has great growth opportunity, and they could, you know, even if they don't turn income on, this client could take 5 years of income and just take the money and walk at this point, right? They could take the accumulation value and they could say, I have something else I want to do with the money. I want to buy a boat, you know, buy a house, whatever. They can do that, right? And having received 5 years of income, they could continue to ride it out until they pass away. They could, and then have money left there. The idea here is that there's still money left in the account. You might be giving up, you know, our Safe Income Plus is a very competitive income product. If I ran the same illustration for that, you might be giving up $1,000, $1,500 a year on the guaranteed income or lifetime income compared to this product. But what you'd run out of money probably in year 13 or 14, right? Probably after 7 or 8 years of withdrawals in this case, the account value would run out of money. Of course, the client would still have a guaranteed lifetime income stream, but there'd be nothing left in the account. We talked about how we have this income doubler, right? I mean, we have this impairment multiplier in case client hits some health problems, end of life problems. But with a product that has that, it's a guaranteed income product, if there's nothing in the account value, that multiplier is not going to last very long, because those only last as long as there's money in the account value. So essentially what's happening is when you're looking at like a guaranteed income product versus a product like this, you're giving up, for this product, you're giving up, there's some risk obviously because it's a performance-based product. You might be giving up some of the guarantees on the income side, but when you run it side by side, you're talking $1,000 or $2,000 a year. The difference is you have the account value that potentially could grow. You have potentially account value that remains when the client passes away. You have the ability to have that doubler on for much longer, that impairment multiplier for much longer. It's just the trade-off, I think, for a lot of clients, especially people that are turning income on when they're younger, is what I'm hearing is worth it to the clients versus a guaranteed income product. So, a few more moving parts, of course, but that's kind of how that works. And I'll scroll down here and show you. Yeah, by the time the account value reaches zero, the client would have, in this scenario, be 85, and they would have taken out $5,000 in the account of the account. So that's what this illustrates at. I would be remiss here if I did not show you the high and low performance here that I did last time on that here. So guaranteed basis, 8,100. That's with that 5% roll up for 10 years, compounding. The most recent that's illustrating here is a little 14. The low period, the lowest 10 years out of the last 20 would illustrate at 10,500 a year, and then the high is a little higher, 14.6. So that's what this has done historically with that index and the what's going on in there. So let me pause for questions. Sorry, I'm kind of cramming this in, and it's 10:30 already.
No worries.
Does it make sense, kind of like from a sales pitch standpoint? Does it make sense why this product would make sense for a good portion of clients?
I mean, it does for me, but we do, just so you know, Matt, I mean, we'll spend a couple more minutes, see if anybody has any direct questions, but yeah, we'll have a discussion afterwards. We have another half an hour with everyone here, but before we go anything else, anybody has any questions while we have Matthew, real quick. So any questions from anybody? Everyone's silent.
Sorry, it's a lot of information. I apologize at the beginning for truly rushing through. I have a 30-minute webinar this afternoon. I apologize, I got them mixed up, but I would just hammer home. I would just say we're very conservative with rates. We've been very consistent with rates. We try to make our products as competitive as possible on a guaranteed basis while also offering upside. And we have the backing that we need as a company. I know we're not a household name. As much as a carrier can be a household name like Athene or Allianz, we're not that, or American Equity. We're not that much of a household name. But the products are solid. The company is solid, and we have the backing that we need on these products and on the company itself to really, hopefully, gain confidence with you guys and with your distribution channel. I'm here as a resource if you need anything. If any questions whatsoever. Again, publicly traded. All of our financials are on our website, fglife.com. Saw some requests for an illustration as well in here in the chat. You can send this over to you, Nathan.
Yeah, send it over. We'll post it in. I appreciate that. Real quick, two resources. You guys mentioned a microsite? Is there something that you have? For illustrations, do you have to have an agent code to run them, or do you have any other information on a microsite? What does that look like? Resource?
Yeah, you do have to have an agent code. Let me share my screen here again. So you do have to have an agent code to be able to run illustrations. Technically, you can download it. It's a huge file, and you could share it that way. But you do have to have an agent code. SalesLink is our website, our agent website. Everything you could possibly want from your new business, your submission, training on the products, you'll have links to the F&G website as far as financial strength of the company, commissions, all that's on here, illustrations, under sales tools illustrations. So now you guys should have a company login as well on this. So if we do need to run illustrations, I can give you our sales desk number, but you should be able to run them as well from your side, Nathan. I believe you guys would have a login.
Yeah, I'll sort that out with 3Mark and stuff like that. But yeah, that makes sense on that end.
Now, one more thing I want to point out now that I forgot about on the website. We have something that nobody else has and I'm aware of. You can correct me if I'm wrong here. We have a suitability tool actually, where you can actually you can sit down with a client in the office and you can insert all their information here for suitability and get an immediate response on if this would match our guidelines or if there's something that's out of line, and go from there. So
nice. As
far as I know, nobody has anything like this. I will tell you that we are the most flexible carrier in the market for suitability and for replacement questions. At least in my experience, much more than our competitors. I would not hesitate to, if you have something you think you're not sure of, just bring it to me and we'll talk through it. Okay, I'll just leave it at that.
That sounds good.
We want to make sure we can do right by you guys and the clients. So.
Perfect. I don't want to keep you on too long, but like I said, any last minute questions for anybody while Matthew's here? All right. Well then, Matthew, I appreciate the time. That was, like I said, it was good information. Just so everyone knows, this is recorded, so you guys will get this if you guys need to review it, and then we have Matthew's information as well. Feel free to use them. Matthew, do you have an internal as well, or is it are you the main?
No, we do have a sales desk. I'll provide the sales desk number for you. I'm doing stuff like this all day long, so my phone probably buzzed like 15 times on this call. So they have somebody manning that at all times on the phones. So
Okay.
if you can't get a hold of me, reach out to them. I'll give you the number here. I'll get an email popped up for you.
Sounds good. That's perfect. Well then, yes, shoot that over. I'll post that in the group band, everyone, so that you guys have resources. But other than that, Matthew, appreciate your time. Looking forward to working with you. This will be an exciting relationship, and yeah, we'll start talking to some people about F&G. Other than that,
That was awesome.
yeah,
Thanks for the opportunity.
Everyone stick on, but we'll kick out Matthew for right now, and then we can talk.
All right, sounds good. Thank you.
Thanks, Matthew.
Bye, Nathan. Thank you, everybody.
All right, thank you, Matthew.
No problem.
Appreciate the time. All right. So as Matthew's jumping off, again, what I want to go over with everyone here is asking the question of value props. That was a mile a minute. That was a lot of information. He talked really fast at the beginning, but two main products that F&G has. Again, this is on the annuity side. We have the Power Accumulator and the Accelerator Plus. And the Accelerator Plus is the income product. The Power Accumulator is their accumulation product. So really quick on everyone's end, based on what everyone saw, what is one area, just name one area. And Renee, you're not allowed to answer if you're actually active, because Renee sells this product a lot. So like she knows this like the back of her hand. She can probably market this with her eyes closed. But for everyone else, just real quick, one thing that you saw that's interesting, that's a value proposition to agents, and there's enough for everyone on here. So go ahead. I'll just go round robin, whoever wants to speak first.
The compounding and BIPs, the price of the BIPs.
Yes. So compounding, guaranteed compounding. That is good. All right. So Jeff got his.
Yeah, I'm gonna go with that impairment multiplier. I like that.
Oh, you and Kristen said at the same time, impairment rider. So I gotta debate which one of you needs to think of another one. Jody, what about yourself?
I like some of the internal investments that they had in there.
It's not an investment. You have your
I know it's a guaranteed index, but it's still the returns. The returns were really good, and it was based on some nice investments.
Yes, absolutely. Which one was your favorite?
I didn't write it down, but I liked some of the iShares.
The iShares, perfect. Yeah. Kristen also mentioned the option to turn the 2-year buy-up on and off, which is really good. Perfect. Well, real quick, Renee, are you actually there? I know.
Yes, I am here. I'm here.
No. Well, if you don't mind putting you on the spot just for like a minute, and I'll introduce you real quick to everyone that's here. Like I said, I know you sell this product a lot. what would you say is one thing that you have experienced that is really beneficial for why an agent should have this in their portfolio?
I guess two things. One is the ability to ladder. I do that all the time. I start with a 1 year and a 2 year, and then on the first anniversary, switch the 1 year to a 2 year so that the client seeing something every year. I think that's really powerful. And then why I like the accumulator product over the accelerator is because what he just covered at the very end, the ability to turn on income when you want it and how you want it for as long as you want it, but still have something in the account value to send to the kids. Because income products, they're great in that they'll continue paying income even if the account balance goes down to nothing, but then there's no legacy play. And so what I have found is on the accumulator products, often you can get, to his point, almost exactly the same income, but still not run out of money, still have something to pass to the kids. Unless you have somebody living, to their well into their 90s, and then, nothing is going to really last that long if they start income early. But those are the two reasons I like it the most. The income doubler is super easy. You don't run out of money with the accumulation, and you're not paying that rider fee for the income product, because I'm kind of allergic to fees. I don't like them, and I don't like my clients to pay them. So I will avoid an income fee, rider fee at all cost if I can justify it. And F&G consistently allows me to illustrate that, of why you don't need to pay that fee.
That makes sense. And my apologies, because I should know the answer to this, or I should have asked him. And I don't think this is the case, just because I know a few of the other carriers in the play. But does F&G allow for internal Roth conversions?
They do. They actually do.
Partial ones?
They will do partial ones. Yes.
Oh,
yeah. They're one of those. A lot of carriers will do full, but very few will do partial.
Yeah, as far as I know, F&G just added to the list. There's only 3 that I know of. Allianz, Athene just came out with it earlier this year, where you can do partial conversions, and now F&G. There might be 1 or 2 others, but that's a really big deal for especially advisors that know their stuff, even
Right.
agents. But that is a very good thing to mention. So between everything that we've just mentioned, these are all great value propositions to be able to talk to an agent about. Again, you're always trying to answer, why should they have this carrier in their portfolio? So any other comments or questions before I kind of wrap up with a few things and talk about, how we can, some of the people you should target, and if you guys have this already in your network, because like I said, this is a brand new product for 3Mark. So anyways, I'm jumping ahead of myself. Any other questions, comments about what you saw?
Nathan, if I can make one more comment as a comparison to Allianz, is that okay? Because I know this is a F&G call.
Absolutely. Like I said, I know this. So this is why we kick off the carrier rep, and we have like a 30-minute time afterwards, so that we can talk freely about the other products. So this is, at this point, this is free for us to talk about whatever, ideally value prop and how it compares and what's out there, but there's lots of different plays. So please go ahead.
Okay. So the biggest difference, Allianz and F&G are definitely my go-to carriers. Rarely will I use another one unless it's a weird situation. But the difference is when you're trying to pull money out. So for instance, I use FIAs as a parking place for money that I'm eventually going to roll and put into an IUL or some other strategy. So with F&G, during the surrender period, they can only take 10% out of the account value, right? With Allianz, you can take 10% out a year of the principal of what you put in. So if you put $1 million in, for 10 years, you could take out $100,000 and move that into some other strategy. And then in year 11, even though you've pulled all the principal out, there is still guaranteed income. With Fidelity and Guarantee, you could pull out $100,000 the first year, but depending on the interest credit, There might not be 100,000 year 2 and year 4 and year 7. So that, if I'm looking for clients that need to get out 10% a year of the principal, Allianz would be the reason that's the reason I would go with Allianz. But if you're not repurposing that, if you're truly just accumulating it to use for income later, then F&G almost always will give a higher interest credit than Allianz. So that's kind of how I justify which one I use. Is what is the money going to do? Is it really just sitting there to be used for later, or am I just parking it somewhere safe and I need to use it between now and this end of the surrender fee?
That's fine. And so real quick, everyone, just because I know this is Renee's first time on. So Renee and I have worked together for a few years now. She runs an agency out in North Carolina, does phenomenal premium over there. And she's right now she's kicking the tires a little bit. We have a conversation yesterday to talk about the AMO program, but I wanted her to jump on because I know she's very familiar with F&G, and having F&G as part of the 3-mark family is something that's, makes it a much easier conversation for someone like Renee to be like, oh yeah, well, I don't have to split up my contracts and things like that in different areas. So just remember that's the one house concept is really, really key. So every time we bring on a carrier, we need to spit that send that out to everyone. Thank you so much, Renee. I appreciate the feedback on that. Any other questions? And then like I said, let's talk about targets real quick, and then we'll jump off. But any other questions? All right. With that said, so let's talk about some targets then. This is, so F&G has grown a lot. And like I said, they're number 2 in annuities right now. So agents are getting more and more aware of them, but I would definitely say I don't have statistics or things like that. I should have asked them, how many people were contracted. But I will say that there's still a lot of market space to be able to talk to an agent and talk to them about a value proposition of F&G, and them be like, well, I don't have access to them, or I don't know who they are, or I'm not familiar with what they do. So that is an advantage that we have right now as well. Looks like they're going to keep on growing, but like I said, there's timing with lots of different things, especially as new products get into the marketplace. So striking while the iron is hot is important. So right now, like I said, 3-mark, literally, we are the first people that Matthew has presented to within the 3-mark family. So none of the other marketers and other people that are within the organization outside of the internal 3-mark organization has seen any of that information. So I jumped on that very quickly. So that's an opportunity for us to kind of bring market share of 3-mark and the platform that they have to other people, specifically with F&G. And not next week, but the week after, I'll bring on National Western Life then as well, because they just added National Western Life on the annuity side also. But talking about targets, so of course, anybody that does retirement income, basically. So if anybody's a specialist in that arena and they sell annuities specifically, this F&G needs to be in their portfolio. So for any of you that are already working with people that are doing that, that's very easy. Come up with a couple of value propositions. Heck, bring on Matthew if you need to, because all of you have direct access to Matthew. Ideally, we don't want to bog Matthew down with every single individual agent. So, but be aware of that. Sorry, Jason, were you going to say something?
Yeah. What have you spoken to Eric Essex about this, and what was his response to adding F&G?
I have not actually. So like I said, the first people, when something new comes out like this, the first people that we talk to are you guys.
Okay.
Because you're the one, everyone here are people that are distributing the products. Eric is a phenomenal agent, and is part of what we're doing with a lot of different arenas with him, but he's not going to distribute this to a lot of other agents. So this would be a great conversation to bring up. I mean, heck, you three can all three of you should separately call Eric and market him on this.
Okay.
That would be good. But yeah, so I mean, take the archetype of an Eric Essex and think about that of other Erics like that, because those would be perfect people to talk to.
I have them on hold right now.
There you go. You bring them into the bring them into the call. We'll make them. We'll role play with them. But outside of that, he did say something interesting, because if you can simplify the message, but because of how powerful it is, the product is, you can simplify the message and get people that are newer to the annuity field, and put this product in their hands. This is something that's great as well. This would be a good introductory. And I will say, I mean, I will really quick, one other very easy value prop, and he kind of skimmed over it because they usually don't talk about comp, of course, with agents, but we're a little bit different. I'm going to pull up the street level comp really quick, because I think it's like a whole point, 100 bips higher than a lot of other products that are out there. So that's something, I mean, outside of all the other value props, literally you can tell an agent that, and that'll work too. So let me see. So yeah, like the Accelerator Plus, the 10, is at 7.5 is street level. So 7.5 is usually probably anywhere between 100 bips to 50 bips higher than a lot of the other income annuities that are out there. So that's really good to know. Yeah, anyways, so we can talk about comp on that end, but newer agents need to have this in their portfolio. Experienced agents, if they don't have it, easy conversation. If they do have it, this allows you to have the conversation where we're full of house. You don't have to keep your F&G contract someplace else, and then get your other contracts with us. You know, we have all of those. And then third area that I would say, just for simplicity, is then look at your guys' current books, and figure out who, because like I said, this is a new product in the 3 mark. If they're already, like, I already know of at least a handful of people that are selling F&G, but they're not selling F&G with us, but they have contracts with us. So that's a very easy thing, that just ask them a couple questions like, hey, are you selling F&G annuities? If you are, you know, where is that at? Can we earn that contract over here? We just brought this on. We can give you a great support with it, et cetera, et cetera. That's probably the easiest one. That's the first place that everyone should go to, is current book of agents. Look at what they're doing. If you've earned any of their contracts on the other side, then you can go back to them and say, hey, you know, just so you know, we just brought on F&G, and we brought on National Western Life as well, but you can talk about F&G semi-intelligently right now, just with what we went over with Matthew. So I would say those are the 3 areas to start with.
Do they allow dual?
You know, that I don't know. That's a good question. I'll write that down. I doubt it.
Yeah, I do too.
Don't know annuity carriers that do dual contracts anymore. Life is a little bit more flexible, but
Yeah, if they don't, we just need to know what the grace period is.
yeah, I would base it at 6 months, but it also depends on where they're coming from, because I mean, that could be a
The
very,
release. Yeah.
yeah. So outside of that, yeah, those 3 areas. So I'm saying newer agents, but I don't mean new agents. I mean like agents that are writing, but they're newer to annuities basically. Because there's a lot of agents that don't do a lot of annuities. So think of those people, advisors, retirement planners, retirement income specialists, people that are already selling annuities. That's the second area. And then the third area is current book.
Are they on Annuity Genius?
Yes, they are.
Okay.
So thank you for mentioning that, Jeff, actually. So they are in the Annuity Genius system. So again, for the people that are doing a decent amount, want to do more annuities, already have a book of business, the Annuity Genius platform is an instant sales presentation that in an instant funnel that makes it super simple to illustrate. And the illustrations, of course, it's, you still have it in the back, but look a lot better than what he just presented, basically.
Well, if you're in need of a brochure and you haven't been appointed or going through the process and you need one, that would be a source to immediately get it for a consumer.
Yes.
Would you be able to put the product guide and the band in a folder, Nathan?
I was going to say, I was going to take everything from F&G that I have. I'm going to put it into a folder and band called F&G. That stuff, like I said, I put Matthew's information in the practice important contacts list, just so that everyone knows. So you guys all have direct access to Matthew. And then of course you can just Google F&G sales desk. You can always call them as well, but I'll put the materials that we have back there. And then of course, use the Annuities Genius platform as well. You can grab the brochures, other information, stuff like that from there, just on the free database.
Regarding calling the sales desk, I did. They will not release information of any kind to me because I am not appointed. And the way it was presented is, do you have your forms, your appointment papers into licensing?
Mm-hmm.
And of course I said no. And they said, well, we can't release anything to you until you are. That was my experience.
Yeah, and so to be fair, because like I said, they're a new relationship for 3Mark. What we can do, and I'll double check this with everyone, when you guys call the sales desk, mention you're affiliated with 3Mark.
Okay.
That may not, it's probably not going to change right away, because like literally they finished and completed, like the contract was active as of Monday.
So give it some time.
Yeah, give it a little bit of time, but we'll have a talk with them, and they'll put in the word. And then, like I said, you mentioned 3Mark, that should be able to get you in.
Okay.
And then if not, like I said, then go to Matthew directly. And then we'll go from there. But I'm excited for F&G. Like I said, great product. There's a lot of people selling it right now. Let's grab some of that market share of F&G products and things like that. And I think it's a great win-win. So if you have any questions, you know where to find me. We can talk about it afterwards. And other than that, we'll talk, of course, next week. Only thing that we have going on is just to mention to everyone before everyone jumps off. I did post on Band that we changed the Debt to Action Plan webinar. So between now, when I changed it now, we just had another 10 people get registered. But I just blanked on the date. I think it's the 13th or something like that. But it's in Band. Use that. Like I said, that's for the whole life people. And anybody that's using Whole Life to teach clients how to get out of debt. Phenomenal platform. We're going to do an agent-facing webinar on that. Other than that, I'll see everyone next week unless we talk beforehand. So have a great rest of your day, everyone, and we will talk soon. I will post the last other thing. I'll post the recording by the end of the day then as well.
Okay, thank you, Nathan.
Thank you, Nathan.
You're very
Take
welcome.
care, guys.
You guys have a great day.
You
do the
too.
same.
All right. Bye-bye.